Building wealth with ETFs seems simple, right? You just buy, hold, and let the market do the work. But there's a lot more to it if you want to take things to the next level. So let me show you how to make ETFs work harder for you so that your net worth skyrockets a whole heck of a lot faster. Starting with the first rule, and it looks like this. Are you investing for the short term or the long term? Imagine you're reading the news and headlines are filled with words like market crash, economic downturn, and uncertain times. Your investment portfolio, which you've worked so hard to grow over the years, starts dipping. It's worth a couple $100,000, and suddenly, after a day, you see it lose an amount that's equivalent to the salary of your first job out of college. The anxiety starts building, and you start questioning everything. All of those what-if scenarios start flooding your thoughts. In moments like these, it's tempting to make quick decisions to avoid further losses. Maybe you consider selling your ETFs to stop the bleeding or wait until things get a little better. But here's the thing, reacting impulsively to short-term market movements can completely derail your progress, especially if you are investing with more of a long-term goal in mind. During the market downturn in 2020, many investors sold off their holdings and missed out on the sharp rebound just a month later. The people who stayed the course not only recovered their losses, but also benefited from the growth that followed after that. The lesson here is that short-sighted reactions driven by fear or uncertainty can derail years and years of progress. Jack Bogle, the founder of Vanguard, put it best. Don't just do something, stand there. Sometimes it's tough to avoid information that tempts you into making short-term decisions. That's why the best thing you can do is stay informed, not influenced. Keep up with market trends, but avoid letting sensational headlines dictate your decisions. Zoom out. When in doubt, look at how the market has performed over decades. Historical trends show that markets recover and grow over time, rewarding those who stay patient and consistent. Which brings us on to the next one. There's no denying that the stock market has been on an absolute tear since the 2008 financial crisis. Think about it. Over the past decade plus, the S&P 500 has hit record highs hundreds of times. Even in years where economists were predicting doom and gloom, the market kind of shrugged off those bold claims and kept climbing. These professionals have been getting it wrong for the past 16 years, and people still take them seriously. Heck, their job security is on par with my plumber who was over at my house the other day unclogging my toilet because, well, now here's the catch. Because the market has done so well, it's easy to feel like it's too good to be true. Headlines constantly warn us that everything seems overvalued, and we hear a crash is right around the corner all the time. It makes sense for any sane person to kind of think, hey, maybe I should sell out now while things are high and get back in when the market drops. Or maybe you're on the sidelines with cash, waiting for the perfect downturn to start investing. After all, isn't it better to buy low and sell high to lock in those sweet, sweet profits? Here's the thing, trying to time the market almost always backfires, and here's why. First, predicting a market drop is insanely difficult. Markets don't follow anyone's predetermined script. Sure, someone might get it right once, but let's be honest, that doesn't make them good, it makes them lucky. The next time they try, odds are they're gonna miss the mark completely. The words all-time highs almost feels like a very rare event, but they're not. They're actually about as common as my dog Molly taking a dump in my backyard and also taking a nap right behind me snoring while I film a video. Let's say you're waiting for the market to crash so you can invest your cash. History shows us that markets spend a lot of time at or near all-time highs during bull runs. From 2013 to 2021, the average year saw about 38 trading days at new highs, which is roughly 15% of the time. If you're waiting for the market to quote-unquote cool off, you might miss out on months or even years of growth, which makes it even more difficult to put your money back in the market. Even when pullbacks happen, they're unpredictable, and the cost of sitting out far outweighs any potential benefit. Waiting for a 3% pullback, on average, the market gains 2.3% during the time you're waiting, which means you're already behind. Waiting for a 10% correction, that often takes years to play out, and by the time it does, the market has usually surpassed where you started sitting out. Put simply, your money is better off invested and growing than sitting on the sidelines hoping to outsmart the market. This is where strategies come in like lump sum investing or dollar cost averaging as you get paid. By investing all at once or a fixed amount regularly, you're removing the pressure of trying to predict the perfect moment. It ensures you're buying in both the good and bad times, taking advantage of the natural ups and downs of the market that no one can consistently predict. Staying invested also saves you from the mental drain of constantly trying to make the perfect call. Peace of mind is a bonus that you won't find by playing the market timing lottery. The real way to explode your net worth is by focusing on the things that you can control, staying consistent, staying invested, and letting time do the heavy lifting. The market doesn't reward perfection, it rewards patience. Help support my little dog Molly as well as this channel by hitting that like button. But to really explode your net worth with ETFs, you're going to need to understand this next rule. In the late 1990s, tech stocks were all the rage. Everyone wanted a piece of the dot-com boom because returns were looking unstoppable. Stocks like Pets.com were hyped up as the next big thing, and people poured their life savings into these types of funds, believing that the sky was the limit. We all know how that ended. The bubble burst, and the countless investors who had chased those astronomical returns were left holding the bag. Fast forward to today, and it's the same story with a little bit of a different outfit. Investors are constantly looking for signals, something, anything that will help them pick the right ETFs to add to their portfolios. And the easiest signal to grab onto is past performance. It makes sense on the surface. If it's done well before, surely it'll keep doing well going forward. But here's the problem. What happened in the past tells us nothing about what's going to happen in the future. Relying on past performance can trick you into ignoring the bigger picture. An ETF might have soared last year because of the unique conditions that might not be repeated. For example, energy ETFs experienced significant gains in 2021 and 2022, driven by factors like rising oil prices and geopolitical tensions. However, in 2023 and 2024, these same ETFs underperformed compared to previous years as market conditions shifted, leaving investors who chased past performance disappointed. Now we can look at this scenario and laugh at those people. You idiots, I can't believe you guys were chasing past performance, but people still do it every single day right now. Investing based on past performance isn't just a guessing game. It's a backward-looking strategy in a forward-moving market. This is where a strategy like investing in low-cost, globally diversified ETFs comes in. Think about it. You're not trying to predict which sector, company, or country will dominate. Instead, you're spreading your bets across the entire market, giving yourself exposure to whatever does well in the future. Yes, you will hold some losing stocks within those ETFs. There's no avoiding that. But here's the beauty of diversification. The winners in your portfolio typically outperform the losers. Over time, the simple approach plays a massive role in exploding your net worth. When you invest, think of each new decision as a fresh start. The market doesn't care how an ETF performed in the past. It only cares about what's ahead. By looking at your portfolio with the lens of kind of like a blank slate every single year you invest, you avoid falling into the trap of chasing that past performance and instead focus on building a launch pad for your money in the future. When it comes to building wealth, most people in the accumulation phase of investing share a common goal: to grow their portfolios as much as possible before retirement. But here's the issue. Many investors don't stop to ask themselves if the ETFs they're buying actually align with that goal. Instead, decisions are often made in a vacuum, driven by trends or what feels like the smart move in the moment. This disconnect between actions and goals can be a huge roadblock to exploding your net worth. One of the most common examples of this misalignment is the tendency to focus heavily on something like dividend ETFs during the accumulation phase. Here's why. Dividends are appealing for one simple reason. They offer regular payouts that feel like progress. It's easy to fall into the mindset that building up dividend income now will help replace your paycheck in retirement. But this strategy comes at a cost, one that can significantly slow down your portfolio growth. Here's the kicker. Many investors who buy dividend ETFs and reinvest the payouts think that they're giving themselves an edge because they can buy more shares. But what's really happening? They're just moving money from one pocket to another. Dividends are simply a redistribution of value within your portfolio. They don't create additional wealth. Instead of creating something special, you're simply recycling money that was already yours. even if the number of shares you own goes up. This decision is often influenced by behavioral biases like mental accounting, loss aversion, income illusion, and the availability bias. These psychological factors can make something like dividends seem more appealing than they really are during the accumulation phase of building wealth. I didn't mean to pick on dividend ETFs specifically, but they're the most obvious example. The real question to ask yourself before buying any ETF is simple. Does this align with my overall goals? During the accumulation phase, that goal is typically to grow your portfolio as large as possible without taking on more risk than you can personally handle. The type of ETF you choose should directly support that objective, whether it's a broad market index fund, a growth-focused fund, or something else that aligns with your personal strategy. Choosing ETFs without considering how they fit into your overall plan can lead to an approach that's more scattered than your ex's chaotic, directionless excuse for not texting you back. Ultimately, staying intentional with your choices ensures that your investments are working toward the financial future that you want. By keeping your goals in mind and focusing on alignment, you'll position yourself far greater for success and flexibility down the road. When it comes to exploding your net worth, there's one silent killer that too many investors overlook: fees. It might not sound like much. Maybe your ETF has a 0.25%, 0.50%, or 0.75% expense ratio. To the naked eye, those numbers seem tiny, almost insignificant. But here's where the trick lies. Small percentages compound to even larger numbers over time, and the longer they work against you, the more that they erode your wealth. Our brains are wired to dismiss small numbers, so when we see them, we're kind of like, meh, not a big deal. After all, what's a 0.75% fee between you and Kathy Wood's ARK ETF, right? It's a small price to pay to gain access to her genius stock picking abilities. These low amounts feel like pocket change in the grand scheme of things. But in reality, those seemingly tiny percentages have an insidious way to chip away at your portfolio year after year. Over 30 years, the impact is massive. Let's say you've built up a $1 million portfolio over your investing career. It feels like you have finally reached that coveted millionaire milestone, right? But here's the harsh reality. Depending on the fees you're paying, you might not actually be a millionaire based on how much it's costing you to invest. Look at these numbers over 30 years. Other than the low-cost option, you can no longer call yourself a millionaire. And this doesn't even account for the fact that the low-cost ETF options perform better than the majority of high-fee funds. The whole thing is a freaking racket and a ripoff. When you opt for low-cost ETFs with expense ratios closer to 0.03%, you're saving tens of thousands or even hundreds of thousands of dollars over your investing lifetime, which also equates to you being able to retire just a few years sooner than someone who allowed these fees to kind of stick around and drain their account. The fees you don't pay is more money that stays in your portfolio, compounding year after year after year, rather than being siphoned off by the billion-dollar investment industry. It's easy to underestimate the power of low costs because they're not that flashy. But if you want to explode your net worth and truly maintain your future millionaire status, avoiding higher fees is one of the most reliable ways to do it. Think about the last time that you checked your investment account. Maybe the first thing that you focused on was the rate of return. It's only natural because returns are the scoreboard that we're all trained to watch. If the market's up, you feel like you are winning. And if it's down, you start wondering if you should have picked a different ETF to invest in. But here's the thing, focusing solely on returns can blind you to what really moves the needle in your financial life. And that is where all of the real magic happens. Let me explain. Imagine two investors, both saving for 30 years. Investor A works hard to pick investments that return 8% annually. Investor B keeps it simple with a diversified portfolio that averages 7% every year. At first glance, you might think Investor A has the edge because of their higher return, but here's how their portfolios actually stacked up. Investor A's portfolio grows to $135,000, while Investor B's portfolio grows to $566,000. How is that possible when Investor B earned a lower return? Here's the key difference. Investor A contributed $100 per month, while Investor B contributed $500 per month. Even with the lower return, Investor B's portfolio is over 4 times larger because they focused on what they could control, their contributions. Why does this happen? Well, math. And because the more money you feed into a compounding machine, the more it's going to grow into. This obsession with chasing higher returns often leads to risky behavior like constantly switching funds, trying to time the market, or pouring money into speculative ETFs. But here's the problem. Those attempts to squeeze out an extra percent or two rarely work. And even when they do, the cost of stress, mistakes, and missed opportunities can outweigh those gains. Always remember that the market rewards patience and consistency, not perfection. If you want to explode your net worth, focus on what you can actually control, your contributions. The more you invest, the more you benefit from compounding over time. Your spending habits. Freeing up more money to invest today is often more powerful than earning an extra percentage in returns. Your behavior. Staying invested and consistent beats any short-term strategy aimed at beating the market. If you want to know why it might make sense to invest in 100% stocks forever, as well as my top 5 ETFs to invest in, then watch these videos to your left next. Hit that like button before you go. I'll see you in the next one, friends. Done.